Welcome to the world of crypto arbitrage, a trading strategy that capitalizes on price differences for the same cryptocurrency across different exchanges. In the fragmented and volatile crypto market, these discrepancies create unique profit opportunities. So, how does it work? The most straightforward method is cross-exchange arbitrage. It involves buying a cryptocurrency on one exchange where the price is lower and simultaneously selling it on another exchange where the price is higher. The key to success is speed, as prices fluctuate every second. Beyond the basics, there are more complex strategies like triangular arbitrage. This involves trading between three different cryptocurrencies on a single exchange to profit from price discrepancies among them. However, crypto arbitrage isn't without risks. Market volatility can erase potential profits in an instant. Transaction fees, withdrawal limits, and the speed of transferring assets between exchanges are also critical factors to consider. To navigate these challenges, many traders use automated bots, which can execute trades much faster than a human ever could. Is it legal? Absolutely. This practice of capitalizing on market inefficiencies is a core part of any healthy market, helping prices to converge across different platforms. While it can be a profitable venture, it requires careful planning, speed, and a deep understanding of the risks involved.